Same businesses, same rules, same clients. But one business looks profitable and other struggles. Why? Accrual with cash accounting and the mistakes most people overlook. Most people think accounting is just about writing down numbers. It's not. The method you pick changes how your business looks, how decisions get made, and where risks hide. Two businesses can have exact same sales and clients, but appear completely different when you compare their books. In this video, you will see where cash and accrual accounting is split, why businesses often make mistakes with both, and how those mistakes quietly affect real decisions. Watch carefully. One simple example later will change the way you see profit. Pass and comment below. Do you record income when cash arrives or when work is done? Accounting isn't about rules first, it's about timing. When revenue or expenses appear, changes how you judge performance. Many business owners think they are improving, but the improvement is just timing. If, if you misunderstand this, you don't just misreport numbers, you misread reality. That's where bad pricing, bad hiring, and cash stress often start. Cash accounting records transactions only when money moves. If a client hasn't paid yet, nothing exists in your records. If you haven't paid a bill yet, it's invisible. This feels intuitive and easy, but simplicity comes with blind spots. When work is done but cash hasn't arrived or bills are due later, your reports can mislead you about how the business is really performing. Accrual accounting records transactions when the value is earned, not when cash moves. If you deliver work today, it's revenue today, even if payment comes later. This method reflects the true timing of your operations, giving a clearer view of performance. This gives a clear this gives a clearer operational picture but requires discipline. Many businesses switch to accrual without understanding it, and that's where trouble begins. Let's walk through a simple example. The same project, the same client, the same price, and the same cost. One business uses cash accounting, the other uses accrual. The reported profits will look completely different, even though the underlying work is identical. This is the moment where most people realize they have been misreading their own numbers. Pay close attention. Understanding this difference is key to making accurate decisions and spotting hidden risks in your business. Imagine a freelancer completes a project in March, invoices the client immediately, but only receives a payment in April. On the surface, this is completely normal. It happens all the time. However, the accounting method you use changes which month looks successful and which looks empty. A cash accounting will show the income in April, while accrual accounting will reflect it in March. This simple timing difference can dramatically alter your perception of performance and decision making. Under cash accounting, March shows no income at all, while April suddenly appears very profitable. If you judge performance month to month, this timing difference can completely mislead you. This is why many businesses think growth is happening or disappearing, when reality is just a timing effect. Understanding this is critical to interpreting your numbers correctly and avoiding decisions based on illusions. Accrual accounting records revenue in the month the work is done, even if payment arrives later. In this example, March reflects actual effort in output, while April simply closes the cash loop. This separation gives a much clearer picture of performance, helping you see whether operations are performing rather than just tracking when money hits the bank. Later, we will show how comparing cash with accrual can prevent common business mistakes. Cash accounting hides unpaid work and unpaid costs, which may be manageable when your business is small, but it becomes risky as operations scale. Those hidden numbers can make you feel more secure than reality allows. Most businesses only notice problems when cash stress hits, not when performance starts slipping. Understanding these blind spots early helps prevent surprises and supports better decision making. Accrual accounting isn't automatically safer if a revenue is recorded before it's realistically collectible. Your numbers can appear more optimistic than reality. This can lead to planning and decisions based on figures that haven't turned into cash yet. A silent risk many businesses overlook. Later, we will show simple steps to avoid these pitfalls and track both revenue and cash accurately. Here is the key mental shift. Profit and cash answer different questions. Profit shows how your business performs over time, while cash shows whether you can survive today. If you only track one, you are essentially driving with half your dashboard missing. Understanding both gives you a complete view, helps you detect issues early, and supports smarter decision making. Cash accounting works well for simple businesses where work and payment happen together. For example, freelancers are small shops with instant payments. It's easy to manage and gives a clear picture in such setups. The risk isn't using cash accounting itself, it's using it in situations with delayed payments or complex operations. Once timing gaps appear, reports can mislead, and you may make decisions based on incomplete information. Once work, billing, and payment start happening on different schedules, accrual accounting becomes essential for understanding the true state of your business. It helps you see what you have earned versus been what has been paid. This isn't about compliance or rules, it's about making better decisions based on reality, not cash timing. Using accrual properly gives a clear picture of performance, helps you plan with confidence. You don't need to overhaul your accounting system overnight. Start by mapping when work is done versus when cash actually moves. This simple step can immediately highlight timing gaps that distort performance. Even a side-by-side comparison of cash or accrual gives a clear view of your business health, allowing you to spot potential problems before they happen before they become expensive mistakes. Small steps like this make your reports far more actionable and reliable. Even a side-by-side comparison of cash with accrual gives a clear view of your business health, allowing you to spot potential problems before they become expensive mistakes. Smaller steps like this make your reports far more actionable and reliable. Accrual with cash isn't about choosing a right or wrong method. It's about understanding what your numbers are really telling you and what they might be hiding. Being aware of timing gaps, blind spots, and reporting differences gives you the power to interpret performance accurately, avoid costly misunderstandings, and make smarter business decisions. If this video clarified something for you, comment below with cash, accrual, or both. If this clarified something you have been confused about, please like and share with your friends. Thank you very much.